I've been honored to introduce our guest speaker today. Our guest speaker, Cliff Morgan, as we all know and love, has been a member of the group for as long as I've been a member, and probably much, much longer. But for those of you who don't know, Cliff has worked with many Fortune 1000 companies for 20 years, understanding their business needs and company goals in order to find ways to increase efficiencies, reduce their costs, and create additional streams of revenue. Now, for those of you who don't know, Cliff currently raises capital for high-end commercial and industrial properties and also provides financial services. He will utilize these skills today and show you how and where you're paying more than you have to on your mortgages, the rule of 78, and why it's more important than ever to build equity in your real estate portfolio today. So please join me in welcoming Cliff to the stage.
Thank you very much. So let me go ahead and share my screen here, and I'll go straight into starting. Okay, can everyone see my screen okay?
Yes.
All right, so today I'm going to show you how the banks are using interest to get paid and how you're going to flip the script and accelerate your net worth by understanding interest. So historically, interest rates have been all over the place. Now, according to Value Penguin, by December of 2020, the 30-year mortgage rate plummeted to a new historical low of 2.68%. Rates spent most of 2021 between 2.7 and 3.1%. And in 1981, continued hikes in the Fed funds rate pushed mortgage rates to an all-time high of 18.45%. Kind of makes you wonder, could we go there again? Now, according to Forbes, our current rate is somewhere around 6.68%. Now, we used to see in our closing documents the federal truth in lending during our closing. Now, I don't know how you reacted when you saw this for the first time, but you may have gasped and panicked like I did. Now, I truly believe that that's why they moved away from truth in lending. And on October 3rd of 2015, this was replaced and added to the fifth or last page of the closing disclosure. And instead of a large legal size sheet of paper, it was reduced to a corner in the upper left-hand side of the last page of a letter-sized document. Most people don't even see. Now, they made this really small in comparison to what it was before. Kind of makes you wonder why. Now, if you notice, there's something new called TIP, and it's right here on the bottom right-hand side, okay? And you'll notice that with this rate of 3.457%, I'm paying more than 56% in TIP. Now, that's total interest percentage. Now, I truly believe in tipping. I really do, for great service. But I don't think I've ever tipped more than 56% on anything. Now, why do lenders demand this? And why is it so much more than the interest rate? Well, let me ask you a question. How often does the average mortgage get sold or refinanced? The short answer is every 5 to 7 years. Now, why is that, you wonder? Well, let me show you.
Yeah.
Okay. So I've created a couple of spreadsheets that I'm going to go over, and this is for 2021. And I've used an average loan amount from 2021 of $313,051. And the lowest interest rate, which was from December of 2020, so your payment would probably start around February, of 2.68% for 30 years. And we're going to put in there the average property taxes that were paid in 2021 of $37.19, and the average homeowners insurance amount that was paid for 2021, which was $23.05. And that gives us a PITI, principal, interest, taxes, and insurance, of $1,768.43. Now, if we focus over here on the right-hand side, we'll see the balance at year 7, okay? This brings us all the way out to January 1st of 2028. The interest that we paid into this so far at 2.68% is a whopping $54,029.57 on a principal amount that we paid in so far of only $52,350.55. Almost $2,000 less than the amount of interest that we paid. Now I look at this and I kind of scratch my head and I'm like, okay, wait a second, this is only 2.68%, right? Well, not really. Remember that tip I was telling you about earlier, the total interest percentage? Well, just on this, it's 45.64% is what you're actually paying. And if you break it down even further and we look at how these numbers look for each year, so I've got the year over here, we can see on the right-hand side, the amount of interest paid and then the amount applied towards principal. You can see the percentage that's applied towards principal and the percentage that's applied towards interest. And if you want to break it down a little bit more, how many of the payments did I make in my first year that actually went towards principal? And in this case, it was less than 6. Okay. If I go a little bit further out, let's go out to year 7 and see what this looks like. Okay. And in year 7, my total interest paid in, there's that 54,000, total principal paid, there's the 52. Okay. And we can see now we've got just over 6 payments being applied towards principal. Yeehaw. You know, the rest is all going to be in interest. So not really encouraging. And let's fast forward to something a little bit more relevant today. Okay. And let's look at the average loan amount this year so far, which across the country is averaging about $413,200. And Forbes just said the most current interest rate is at 6.68%. Some people might be able to get it for a little bit less today, but we're just going to use where they say we are. So the first payment, if it started today, might be due somewhere around November 1st of 2022. We're going to keep the property taxes and insurance in the exact same place that we had it for 2021. And we're going to look at how this changes. So you can already see our PITI is considerably higher than what we had with the 2.68%, but we also have a higher loan amount too. So both of those kind of work in together. We look over here for the balance at year 7, we see how much we're paying in towards interest. So at year 7, we paid in $185,000 in interest. And in principal, we've only applied $38,409.97 to principal, a far smaller amount, leaving us still a pretty huge outstanding balance on that original loan amount. Mm-hmm. And when we look down below at that tip again, this will make your eyes bulge, you know. And again, I truly believe this is why they did away with the truth in lending document. It's 131.82% is what you're actually paying in there. So on the original loan amount, we're actually paying twice and almost a third again on top of that to get this loan. That's a lot of money. Now, if we break this down similar to what we did in the previous example, we'll see here again for year 1 how this breaks out. And we see the amount that we paid in towards interest at just over $27,000. But the amount applied towards principal is just over $4,000. Okay. The amount applied to principal, now you can tell there's a huge difference in this versus the 2.68%. This one, we only have 13.98% being applied towards principal and 86% being applied towards interest. Less than 2 payments in the year is actually going towards principal. Our total interest paid, $27,000, $4,000 for principal. And we go down to year 7 to see how this looks. And we have the same numbers that we have up above, but we also have our percentages. So 20% is applied to principal, where 80% is applied towards interest, even at year 7. And approximately 2.5 payments are being made towards our principal at this point. Okay. And then where would you think that the halfway point would be in the amount that you pay in for the year, balancing out to where the interest and the principal are about the same in the same year? Most people would say it'd be around year 15. But if we go to year 15, you can see we're still at a 64.48 versus 35.52, with a smaller amount going towards principal. Now, only 4.25 payments approximately are being made at year 15. Remember, we're at the halfway point of a 30-year mortgage. Now, it's not until we go down to about year 20 that we start to see this balance out pretty close, and we're still not quite paying more in principal than we are in interest, and we have just below 6 payments being made in that. But then we're also at year 20, we're 2/3 of the way through a 30-year mortgage. And remember what I said earlier, the average mortgage is sold or refinanced every 5 to 7 years. So do we ever really see this typically? I venture to say the answer to that is no. Okay. Let's come back over here and let's show you a couple of numbers. All right, so when does 4 equal 24 and 8 equal 40,320? Well, if you have just 4 accounts that charge interest, there are 24 different ways that you can potentially build equity. But if you had 8 accounts that charge interest, like loans, credit cards, and mortgages, to build your portfolio, there are over 40,000 ways that you can build your equity. Now, at this point, I think you might be able to start to see how there could be some opportunities here. Okay, so let's jump right in and start off by talking about some technology. More specifically, though, let's talk about technology that we all tend to use today, GPS. It's a technology that changed the world. We just tell it where we want to go, and in an instant, not only does it give you the fastest route to your destination, it can also help you avoid certain places that might slow you down. Of course, all kinds of new technology comes to the market every day. But some advancements are the kinds we can't imagine living without, like cable television, the internet, smartphones, and countless more. These technologies have made such an impact that we use them in our day-to-day lives. And they're so important that we'll get someone to fix it the same day if they aren't working right. Well, imagine for a moment if we could leverage a sort of GPS technology that would do the same thing that our finances, and let's call it a financial GPS. It would help us get to our desired financial destination on the fastest possible route. And even more, it can also help us avoid any of the areas that may slow us down. Now, the destination is different for everyone. Some may want to go to the financial destination of owning their real estate outright, and they would like to get there as fast as possible. Then again, some want to go the financial destination that builds equity quickly so they can leverage that out when the time is right and expand their portfolio. Both are great financial destinations, and we've been helping clients successfully arrive at their desired financial destination with our financial GPS for more than 18 years now. Now, our financial GPS analyzes every aspect of your financial situation: income and expenses, amount financed in terms of each amount charging interest, reserve amounts, fixed versus variable rates, different loan types, and unexpected expenses. Now, what would your business be like, or how would it be different if you had a financial forecasting tool that could let you know whether or not you could afford a new property and how long you could carry it without rental income? What if you could buy a new truck financed for 60 months and potentially pay it off in 2 years or less? Many people think they know what this is, but first, let me tell you what it's not. It's not refinancing. It's not changing the standard of living. It's not a biweekly program. It's not a debt roll down program. It's not a reverse mortgage. And it's not a concept or theory. It's just math. And oh, by the way, it's also not a manual spreadsheet. This program enables you to control your cash flow and accelerate your net worth. Our program supports up to 100 properties. It always focuses on 3 things. 1, it makes sure everything is paid. And 2, it makes sure your reserves are met. And 3, it's constantly finding the fastest way to build your equity. And this program can also help you identify funds so no dollar goes underutilized. And it can also help you create equity even in a down market. You will know exactly how much to apply and when to apply the funds for maximum benefit. And the program automatically adjusts every time money moves in or out of your plan. If you have a line of credit, you can potentially take advantage of interest float as well. Now, if you want to take your camera out and take a picture of this page, it will make it easier to find these books a little bit later. I'll be putting a QR code up on the next screen, and you can see, you can use your camera to actually follow that link where you can schedule a complimentary consultation with me. And it's important to understand real estate has market cycles, and you want to understand what strategy to employ at each stage of the market cycles. These 2 books do a really good job of explaining what to look for in order to identify what phase you're currently in and the best strategies for that particular phase. For what is coming, building equity quickly can put you in a very strong position should real estate drop in value and the banks make it difficult to qualify for a loan, just like they did back in 2011. Now, during our complimentary consultation, you'll see how the program works and learn how quickly you can build equity. If you don't already have your camera phone out, pull it out and schedule with me now. If you have an Android phone, you may need to select modes and then the lens to capture the QR code link. And if you don't have your camera phone handy, you can manually type the link that I have right here in your browser and schedule with me later too.